Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. When you think about buying a property, you think about things like cash flow, appreciation, tax benefits. But to get all that stuff, you got to do your homework. Today, we're going to talk about the importance of due diligence and underwriting a deal. And we've got an awesome guest on the Real Estate Guys radio program. Hear ye, hear ye. Registration is open for the Real Estate Guys 21st Annual Investors Summit, a mansion spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year is the editor of the Gold newsletter, Brian London, real estate developers Beth Clifford and Victor Monash, and Jim Rohn's 18-year business partner, Kyle Wilson. Also back, the rebel capitalist George Gammon. And joining us live and in person for his 11th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet. It all begins June 6th in beautiful Ambergris Caye, Belize. Visit Summit on Sand to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to summitonsand.com and make plans to spend a week with the Real Estate Guys, George Gammon, Ken McElroy, and an all-star faculty on the 21st Annual Investors Summit on Sand. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and joining me, it's our co-host, financial strategist, Russell Gray.
Hey, Robert.
Last week on the show, we had the amazing Kenny McElroy and talking about little macro and a lot of apartments. And today, we're going to delve further into a very important part of investing in apartments or any kind of real estate, and that is underwriting and due diligence.
Yeah, when you take a look at getting into a deal, it's your responsibility to understand the deal you're getting into and how it works, even as a passive investor. I used to sell securities way back in the day, and one of the things we were required to do when someone was going to look at putting money in a mutual fund is we would hand them a thing called a prospectus. This is, in the syndication world, what we call a private placement memorandum, but they're even more gnarly, big, lengthy documents. And it's basically just complete disclosures of everything to give a prudent investor all the information they need to understand the investment that they're making. And this is something that the SEC requires. But like getting a real estate license or a lot of licenses that you can get in the world, sometimes there are things that you get that are enough information to satisfy a regulator, but they're really not enough information to make a good business decision. And so underwriting is the act of taking a look at all of the critical pieces of a deal and making sure that the representations are supported by a reasonable documentation and third-party validation of fact. In the mortgage business, that's what we would do. We would take a credit application, and it consisted of underwriting the borrower's income, the sources of income, their savings, where the down payment was coming from, their credit score, which was a reflection of their history of paying their bills on time. We'd underwrite the property, the condition of the property, third-party appraisal. You had to put all this stuff in your file in order for the lender who was going to make the investment of lending the money to the borrower, helping them make a good underwriting or business decision. The same thing is true when you're buying any type of an investment deal. So when market conditions change, as they have, and margins get tighter and the critical inputs maybe have changed a little bit, you always have to go back and really revisit your underwriting guidelines and making sure, do they still fit the market that we're in? And I think we're in one of those changes right now. So we thought it'd be a good time to do a show and just talk about why sound underwriting matters more now than ever before.
When you think about what underwriting is, maybe that's not a term you're even used to. If you buy single family houses, you might not think about it. And Russ, your point, the lender is always underwriting you. So what they're doing is verifying everything that you're presenting in terms of your financial picture. So you say, yeah, I have a great job and I have good credit. They don't just take your word for it. They go, awesome. Fill out the application, sign here, tell us where your accounts are, where your assets are, and then the underwriting team goes to verify all that. Oh, look, she does have a great job and has been there a long time and makes good money. Oh, look, she has had a bank account here for many years and it's in good standing, right? That's the process you would go through as a prudent lender to make sure that the borrower has what it takes financially to qualify. When we talk about underwriting an apartment building, it's really no different. The seller says, oh, I get this much rent, and oh, I have this many tenants, and oh, they're on this long of leases, and oh, we have deposits. Okay, then you go through the process of verifying that, making sure. Sometimes we go into a marketplace and we're not that concerned with the current tenants. We know what the market is. We can see that there's demand. And yeah, we hope some of those tenants stay. But if our plan is, say, to do a lot of work, a lot of CapEx, capital expenditure, we're going to move some people out, then we're less concerned than that. Russ, you and I did a project a bunch of years ago with 64 units where we ended up dumping everybody out who was the current tenant. And then we didn't really care about the rent roll as much. If what you're buying is an apartment building and you're relying on the income that it produces, and you better be really sure that you know what that income is and its durability and where it comes from and how it's documented and all those things. So underwriting is not necessarily the fun part, but it's critical. Until you have underwritten a deal, all you have is a best guess.
And I think in those circumstances, when you aren't doing the deal, but you are an investor in the deal, kind of like a person who is buying the mortgage. I know a lot of people, I'm going to come at it from a mortgage perspective because that's my background. But in the mortgage business, you have investors, and they're not the people borrowing, they're the people lending. But they don't lend directly. What they do is they put all their money in a pool, and it's represented by a manager who then invests that capital and looks for loans to invest in that are created by people on the front lines called mortgage originators. These are the people that the borrowers deal with, and they make those loans and they package them all up and then they send them back. And even in the lending world, it's not just about the borrower and it's not just about the property. They also take a look at the market. If you're in a market that is declining in terms of property values, sometimes the underwriting guidelines change. In other words, we won't loan as much. We need more down payment. We want better quality borrowers with higher reserves and lower debt to income ratios, more than enough income to service, even if the market gets tight. And so a lot of the principles of underwriting that you have been through just as a Main Street borrower are the same principles that you would use putting yourself on the other side of the table, whether you're an active sponsor or an active investor at a higher level, or whether you're a passive investor. And I think when you do get to the point where you're investing in commercial properties, a lot of times people don't understand that putting debt on a commercial property is actually one of the best things you can do from an underwriting perspective, because that lender is going to underwrite that property strongly because they're relying upon the income of that property to service the loan. They're not relying on the borrower. You know, no borrower is going to be making a $30 or $40 or $50,000 a month mortgage payment, right? That building is going to be doing it. Sometimes when you have debt on the property, you've got a partner, if you will, in the lender who needs to make sure that that's real. So most of us really understand the concept of underwriting, but then how does that really translate into Main Street when you're out there looking at deals, and especially probably at what is still the most popular asset class in real estate for serious investors, and that is apartments.
And underwriting isn't just getting to a level of understanding, it is taking on financial risk. There are no guarantees. Clint Eastwood says if you want a guarantee, buy a toaster. If you buy an existing apartment building, there's a chance that something could go wrong. The way we mitigate and minimize those risks is through the process of underwriting. We come back, you're going to meet a gentleman that's been doing this a long time. He teaches people about investing in apartments and has personally invested in thousands and thousands of them. Brad Sumrok and his students have more than $1 billion of apartment buildings right now. When we come back, you'll meet the man we call the apartment king, Brad Sumrok, as we talk underwriting a deal today on the Real Estate Guys radio program.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
Hey everybody, it's Ken McElroy, and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit on the Sand in Belize coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Now in our 27th year of broadcast, we're talking today about vetting and underwriting a real estate deal. What do you look for? What's important? To help us in that discussion, let's meet a man who knows a thing or two about market analysis, property due diligence, and underwriting. We call him the Apartment King. Brad Sumrok is with us. Hey, Brad.
Hey, I'm glad to be back here again. It's been a while, but I'm really excited today.
Well, it's great to have you on the show, and it's great to watch you navigate the changes in the market. When we first met, Brad, it was a very different real estate market, and as things have changed, as the markets have gone up and down, and interest rates have gone up and down, and the pandemic has come and gone, you've made the necessary changes. You've been in the apartment space more than 20 years now. And I remember the first time I went to your live event, Rat Race to Retirement, and watched you for 2 days. It was mostly just you on stage talking about every single aspect of investing in apartments. I thought, man, this guy really does know his stuff. I'd seen you speak at an event for 30 minutes and thought, yeah, okay, well, he seems to know his stuff. But after 2 days, my goodness, it was clear that you don't have just what we call head knowledge from reading books and listening to podcasts, but seat knowledge from spending time in the saddle. And so what I wanted to do today was pick your brain on underwriting and due diligence. Everyone understands why they want to own real estate, but not everybody understands how much work is involved on the front end to make sure you're getting what you came for. But before we get to that, and we will, I want to have you weigh in a little bit about the changes we've seen in the economy and with lending and just crazy myriad changes in the last 6 months. We're here in the second quarter of 2023. Give us the high notes on where things are happening and how the apartment business is being affected right now.
Yeah, well, let me take a step back to about a year ago. Okay, so a year ago, roughly first quarter of 22, interest rates were still at 3%. You know, we could get 80% of a purchase price, maybe 80% of the rehab at a 3% borrowing rate.
Yep.
And so it was essentially free money. And that created a lot of excitement in the market. And what people didn't realize is because debt was so cheap, you could buy deals and still get a great cash return. On the other side of the coin, there were 20, 30, 40 buyers chasing the deals.
Right.
And sometimes, not all the time, but sometimes that frenzy would drive up pricing. But even with pricing at a premium, the projected returns were still really good. So it was like, you know, the golden years. And then coming back to the pandemic, I mean, I remember there was going to be rent strikes and eviction moratoriums and all this type of stuff. And that didn't happen in these landlord and friendly Sunbelt markets where there's job growth and population growth, and 99% of the people paid the rent.
Right.
Even if they were at home, the government paid them to stay home.
Yep.
So it was a great time to be in the business, and our values just went up and up and up, and people made a lot of money. Well, because of what happened, and you know, I'm not going to sit here and talk to you about what happened. You and the rest of the faculty on your events that we're all friends with, you know, we all know what happened.
Right.
They created this situation. They printed money. They gave money to people to stay home, and now they're trying to create a recession, right? So they start raising interest rates because inflation hits 9%. And it was unprecedented. I mean, if you look at what happened over the past, starting the second half or the end of the first half of 2022 until now, it's unprecedented, like never before, or at least in my lifetime.
Yeah.
And I'm 55, by the way. Never before in my lifetime has rates went up so much so fast.
Yeah.
And how do you budget for that? Like you don't. And so the other phenomenon that occurred is the last 2 years, virtually every deal that was purchased from not just me and my community, but just about everyone I know was a variable rate loan. And 87% of the time, variable rate loans are more profitable. But, there was a very wise man that said you got to survive 100% of the time, not 87% of the time. So what happens in that 13%? So what happens is you buy a rate cap. You buy insurance to make sure that if rates do go up, that you're protected on, for them going up too much. So I have variable rate loans with rate caps. So do people that are mentors and guides to me, people that have 10, 20, 30,000 doors, like we're all there. And most of us are going to get through these deals because we're experienced, we have strong teams, we have liquidity, we have a certain level of sophistication, we pay attention to our deals. There are going to be people that aren't going to be okay.
Yeah.
And some of them are already, out there. Maybe they went too big too fast. Maybe they got ahead of their skis. Some of these people didn't have rate cap insurance.
Well, let's talk about that for a minute because financing is different for apartments and other commercial uses than it is for residential property. I mean, people do live in apartments, but in terms of the loan categories, residential loans are 1 unit, 2 units, a fourplex, basically anything from 1 to 4 doors. Once you pass that, now you're in commercial lending. And unlike the residential space where, hey, if the rates change, we can just refinance pretty easily, it's not like that in commercial. When you commit to an apartment loan, that lender is making a commitment for a period of time, 5 years, 10 years, and it's not easy to get out of those loans. When you're looking at an apartment deal, you've got expectations based on where the market is today and how long you expect to have the property. In the last year or so, we've seen a lot of folks choose to take variable loans instead of fixed rate loans. There's been some good reasons for that. And when you have a variable loan, it's typically tied to some index, and obviously the rate can go up or down. And in times of uncertainty, a lot of folks choose to give themselves some extra protection. Last week, we had our mutual friend Ken McElroy on the show, and we were talking about rate caps, basically insurance against the rate going up. Tell us about your experience with rate caps.
Well, okay, and this is really interesting. So like I bought a deal in December of 2020 with a variable rate loan, and my rate cap was $40,000, and there was a cap of 2 additional percentage points. Okay. So my initial rate was 2.74, believe it or not, which means the most it could ever go was 4.74. Well, rates went up to 7. So I'm in the money for that period of time, if that makes sense. I'm in the money because if I didn't have the cap, I'd be paying 7%.
Yep.
And that cost me $40,000.
Okay.
Now, in 2 years, that same rate cap would cost me about $1 million.
Right.
And so what the market does is they reprice. It's just like you could buy insurance in Houston, Texas, and it costs a certain amount of money. And then there's a huge hurricane, and they pay out billions and billions of claims. And then everybody's insurance doubles and triples.
Right.
Depending on the market, rates never went up that fast.
Right.
When I bought it in 2020, it was $40,000. Now it's $1 million. So what we're seeing is we're seeing a lot of syndication groups, a lot of investors that got into these 3-year shorter term loans, and now their rate caps coming due. And they might have paid $80,000, $40,000, $100,000 for that, and they budgeted that amount, but they didn't budget $1 million, $2 million, $3 million, $4 million. Does that make sense?
Yep.
Yeah.
And because rate caps are also for a period of time usually.
It's a period of time. Yeah. So just like any other type of insurance, it goes with supply and demand.
Yep.
And so the whole irony is everybody I know right now thinks rates are going to be lower in a year from now than they are now.
Well, this brings up a great point, Brad. When you look at financing, say an apartment building or really any property, you're taking your best guess and your lender's best guess and your mentor's best guess and the market's best guess about where rates are likely headed. If you believe rates are going to go up, then you take prudent steps like getting a rate cap, as long as those numbers make sense. If you think rates are likely to go down, then perhaps you're fine with a variable rate adjustable mortgage. And the premise is, in that kind of environment, that we'll do better over time if the rates can adjust. If you think rates are headed up, you got to take prudent action. Back in the day when we first met, almost everybody was doing fixed rate financing because that made sense. The rates were reasonable, and we had that surety, that certainty of what our payment would be for the duration of the loan. Well, once we went through that period of cap rate compression and more dollars chasing real estate and 10 bidders at best and final, well, now all of a sudden it's a different ball game, and you have to make decisions, not just for financing, but the basic decision, is it too competitive? Do I sit out the market? Do I look for opportunity? And I think that's going to lead into our primary discussion about underwriting and due diligence and taking the steps to make sure that a property you have in your sights is really going to work for you and your investors. And Brad, it seems like every time we have you on the show, there's been a market change, and you've had to pivot and make adjustments. And the only thing certain is change. So today, where you sit, if someone's thinking about getting into a property, what are the critical factors when it comes to underwriting and due diligence?
Well, here's what I always say. Like, when you look at a deal, I break it into three pieces. There's the property itself. Yep. So there's the building, the rent, the number of doors, right? The amenities. What's the current rents? What's the projected rents? What's your value add improvement? So that's one piece of the pie. Yeah. So that's what I'm going to call the deal, or let's call it the property. Yeah. Okay, because the deal encompasses all three of these things that I'm going to say. Okay. So we call it the property, and then we call it the market or the submarket. Yeah. So the same property moved into a different location is not going to perform the same. Right. And this is where some people that like engineers, they think, hey, if they build it, they will come. No, if you build it, they will come if they can afford it. Yeah. Right. So you don't want to over improve an asset where the median household income is $30,000 a year, and you don't want to do the same level of improvements as if it were $60,000 a year. They can't afford it. Yep. So you got to understand the market, the job growth, the demographics, and that's important. So there's the market due diligence. Yep. There's the property due diligence, and that property due diligence is the one that most people think of, inspections and physical characteristics and upgrades and all that type of stuff. And then the third piece that's the least talked about out there, but it's the most that I talk about, and it's the one that I say is the most important, is actually the people leading the deal, which I'm going to call the general partner or the GP team. Yep. When there's a strong wind against your back, you could be average and still make a lot of money because that wind could be very forgiving. The wind is blowing at your back, and you could make some missteps or some mistakes and still do good. And that's what happened in the past decade. Yeah. And so a lot of people haven't been in the business like I was in 07, 8, 9, and 10. And so or if they were, they forgot. Right. And so, one of the things I always would say from the stage is like, how much experience is there? How much can you control the deal? How long have you known your co-general partners? The worst thing that can happen is having arguments on the GP teams where they're having disputes about how things should be handled. And I've seen that, and I always tell people, like, if you're going to get into a deal either as a limited partner or as a general partner, this could be a 3 to 7 year business marriage. And so you got to get to know, like, and trust the people you do business with. And so those are to me, the three components of a deal. It's the property, the team, and the market.
Well, let's start with the market, because before you look at a specific property, you need to identify a market or markets that make sense to you. And there are so many variables there. I know you have kind of a formula you use when selecting markets, and that has served you well. I know that you and many of your students like to buy properties. They're in pretty good shape, don't need a lot of work, they're already performing. But you also find opportunities when there's been a lazy landlord or some sort of challenge, and there's a chance to do CapEx and really change the nature of the property, sometimes the tenant base. So studying the market's important, and within the market, the sub-market. And obviously, we look at things like employment and net migration and trends and the direction of rents. Can you speak to some of those things?
Yeah. So, if I just go through the recipe that I've been doing for 22 years, I mean, number one, and I'll answer that question and I'll get there. But number one is I want to be in a landlord-friendly environment where we have a fair chance to win.
Yeah.
So I like areas where that have governments, state governments that are more business-friendly and landlord-friendly, and are less likely to implement, rent control, or less likely to implement things that punish landlords for providing a service.
Yep.
Okay, so that's important.
That's a tremendous shortcut, by the way. That is a gold nugget. In the U.S., not all 50 states are the same when it comes to tenant-landlord law.
Right. Like somebody will say, hey, I got this great deal in Los Angeles, and I'm like, I'm out.
Yeah.
Like, I don't care how good the numbers look, but you can only raise rents there so many %. And it's probably going to get worse because of the laws there and the legislatures and the city governments and stuff like that. So I'm just going to stay away from that. So to me, that's rule number one. And then I look at things like, what's the job growth? And is the jobs a diversified economy, or is it one major employer? Like, let's say, 40% of the town works for the General Motors plant or the military base or the university, and that university is shuttered like it was in the pandemic, or the military base closes like it did under whichever president, right, decides to close that military base. Your economic base could be destroyed. So I look for a diversified economy with job growth above the U.S. average. I look for population growth above the U.S. average, because these are things that matter, and these are some of the biggest economic drivers and predictors of how apartments are going to perform. So apartments are recession resistant, but they're not recession proof. And to make it more recession proof, you need to be in a great market. So those are a couple of things I look for. I look for median household income in the 1 and 3 mile radius, because you could build the properties being built, you could improve it, but you're going to be pulling people in from that 1, 3, and 5 mile radius, because those are the people most likely that are going to be wanting to live at your property. So those are things that I look at too. And then you got to know the nuances of rent growth, expense growth. And let's talk about expenses. Like in some areas, take like Houston, Texas, or some of the coastal areas of Florida. Like, I bought a property in St. Pete, Florida 4 years ago, and we were paying $600 a unit for insurance. And now we're paying $2,100 for insurance because they've had a lot of hurricanes in Florida. Fortunately, our rents are up 48%. And so we're still making money, right? But it's like, so you got to understand that there's a projection. And projections are usually based on averages and historical trends. At least that's how I underwrite deals. Yep. But then there's the reality, which is there are times where there's going to be higher insurance costs. And insurance doesn't always go up, by the way. If there's a lot of claims and they're paying out billions of dollars in that market, you're going to have less competition. You're going to have the current providers will stop writing new policies. And so the rates are going to skyrocket. Yep. And then over time, if there's not that many claims, you're going to have new providers come in that market and say, hey, I could be very profitable here, and I can undercut the competition. And this is what's great about capitalism. And so insurance goes up, insurance goes down, property taxes tend to go up. Values have skyrocketed since the pandemic, and now we're seeing a year or two lag effect, and property taxes are skyrocketing all over the place. Yeah. And, if you budget a 2 or 3% expense increase, right now taxes and insurance have gone up a lot more than that. Yeah. So some of these things are unbudgeted. Labor has gone up more. Now, on the opposite side, rents have gone up way more than what we've projected. Yeah. Okay, so when you underwrite deals, you got to know the historicals, and you got to know what's happening right now with rents, with expenses, cap rates, reversion cap rates. There's been pricing reset in the market. So cap rates today are probably 50 to 100 bips higher than they were a year ago. Now, it's not 200 or 300 bips. It hasn't gone up that much. But, if you underwrote something at a 4 cap last year, like a nice B-class property in DFW would probably sell at a 4 cap last year, and now it might sell at a 5. And so you got to know that. Yeah. You got to know that when you underwrite these deals.
Well, this underscores a really important point. It's easier to look out 1 year ahead than it is to look out 5 years ahead. And your typical desired hold might be 3, 5, 7, 10 years. So you have to have some margin in there for come what may. I don't think anybody forecasted the pandemic shutting down business and commerce the way it did. And I remember we talked about it, Brad. What's going to happen? Are 40% of my tenants not going to pay? Is everyone going to move out or just shelter in place without paying the rent? Obviously, and thankfully, that didn't happen. Now, part of that's prudent underwriting because you don't have all of your tenants in the same industry as far as employment. And part of it's kind of luck of the draw. So as you're looking out into the future, what kind of adjustments do you make, even psychologically, to prepare yourself for a changing market? Because nobody knows exactly what's going to be happening 5 years from now.
Well, here's a couple of tips. So like for people that already have deals, like I'm a GP in like 17 deals right now. Yep. So we underwrote the deal when we bought it. So what everybody should be doing that has deals is, I would say, be re-forecasting or re-underwriting your deals based on what you know now. Yep. And you don't want to knee-jerk to the opposite side. Like if someone starts putting in and say, well, this quarter we had negative rent growth, so for the next 5 years I'm going to put in a negative rent growth. It's not going to be negative like that for the next 5 years. It's just not. Yeah. Like it never has been. Okay, but you might have a negative rent growth for year one and then kind of go back to some historical norm, in year 2, 3, 4, and 5, right? And so over time, what normally works out is if you can know what the historical norms are, over time things gravitate toward that. But part of being a sophisticated investor, part of being an investor that understands the upsides and also some of the potential downsides is things rarely perform as projected. When things outperformed the projections for the last 10 years, everybody was so happy. Right. And now we're going to run into a time where some people aren't going to be happy. And so, again, what I would say to all the active syndicators out there, the GP teams, is you want to be re-underwriting your deals. You want to be, doing what I call stress testing your deals. How low could the occupancy go? Or, what's the updated reversion cap rate? Update your expenses. It's probably different and higher than it was when you bought the deal a year or two ago. And so you should do that. And then you got to communicate to your investors. We communicate the good, the bad, and the ugly, not just the good. And what some people do is they're only communicating the good, and then when things aren't good, they just go silent. And that's worse. Like investors deserve, but they also, if there is something that's not happening good and you tell them what happened, why it happened, how it happened, and what your plan is, that's a much better plan of attack than to not say anything.
Brad, Ken McElroy says, delivering bad news builds trust. Nobody wants to deliver bad news. We love to deliver good news. But when things do go wrong, or when your projections are clearly needing to change, the best thing you can possibly do is communicate that with your investors. So clearly, market selection's important. I know you could talk for another half hour about that, but let's transition into the property itself. Once you've found a market, it makes sense, you've got good relationships with brokers, you're looking at deals, you find one. Now let's talk about specifically underwriting the property. What are the things that matter the most when you're taking a look at the physicality and performance of a property?
Well, so one of the things is the debt. And again, last year we'd underwrite a deal with 3% interest rate, 80% loan to value. Now it's 5.5% interest and 65% loan to value. Yeah. So that changes the fundamentals of the returns.
Right.
And then you need more equity. So again, maybe it's not directly what you asked, but people need to know. It's like, look, a lower loan proceed and a higher interest rate is a lower cash return, more equity down payment. So the first thing I tell my students is now you're going to have to raise more money.
Yep.
And how are you going to do that? So maybe you should be doing smaller deals right now because, the equity raise is going to be, for the same size deal, the equity raise is going to be 50% more or 40% more. And so that's something that to me is part of at the property level when you're sizing up the deal, it's like, what's my debt? What's my equity? Do we have loan guarantors that could get this type of debt? Do I have investors or do my co-general partners have investors where collectively we could go out and raise this much money? Yep. And then, you got to do your physical inspections. And, you don't want to miss things on that. You want to walk all the units. You want to have all the major systems checked. The roofer check the roofs. The AC guy check the ACs. A plumber check the sewer lines. An electrician pull the wiring and the panels to see if they're, still in compliance or in code. Or, sometimes lenders or insurance companies will make you replace them. And if you didn't budget for that, you could be hit 2 weeks before closing that you need to go in and replace all your panels for hundreds of thousands of dollars. And it's like, I didn't know that. And it's like, well, but you should have.
Well, and this is a great point. A lot of people think, well, I want to save some money by just hiring a general contractor. Instead, I've watched you kind of mobilize your forces, if you will, and get a lot of different professionals out at one time. Let's face it, disrupting tenants is difficult kind of at any stage unless the property's empty. So when you have an opportunity and the current seller is given notice through their property manager and all that, you want to make the most of it. And of course, the property itself is going to make a difference. If you're buying something that was built 2 years ago, that's going to be different than if you bought something built in the 80s.
Yeah, so we check, you want to have a team check all the major systems, foundation, roofing, plumbing, electrical, walk all the units, check all the appliances, all the laundry equipment, if there's a pool, if there's pumps. Like, by the time you own the deal, Robert, you should know what you're getting, and you should have a budget for what it's going to take to get the property to the level of capital improvement, renovation, or deferred maintenance that needs to be cured. That should be known. Now, yes, could something happen after you own the deal where you didn't see? Yes. But if you've done a good job, it shouldn't be something major. If something major happens, it's probably because you missed something major.
Our guest today is the Apartment King, Brad Sumrok. We're talking about underwriting a property. We've talked about the market and the property. When we come back, we'll talk about the third component, the people, the partners who are making the deal happen. Plus, we'll play real estate trivia and give you a chance to win a prize next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Hi, this is Anthony Melchior from Hotel Impossible, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you've been thinking about coming on the 21st Annual Investor Summit, it's time to stop thinking and start taking action. Just a few spots remain. If you want to join us in beautiful Belize, along with our good friends Kenny McElroy, George Gammon, Dr. Chris Martinson, Kyle Wilson, Victor Minash, Beth Clifford, and lots more, just send an email to summit@realestateguysradio.com. That's summit@realestateguysradio.com. We're talking today with the Apartment King, Brad Sumrok, about what it takes to do the due diligence on a property and the proper underwriting. Before we get back to that discussion, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. When you hear the question and think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address, because the first person that gets it right gets this cool book called Think Big. It's a collection of inspiring stories put together by our friend and Jim Rohn's 18-year business partner, Kyle Wilson. That can be yours if you know today's real estate trivia question. Last week, we had Kenny McElroy on the program, another amazing apartment investor, talking about current market concerns. We asked this: what U.S. state currently has the highest rent? Well, according to data from Zillow, New York is still the state with the highest rent in America. with a median rent of $3,200 a month. Here's our real estate trivia question for this week. Unemployment is mostly down. Well, here's what we want to know. Which U.S. state has the most job openings? Yeah, in spite of fewer jobs being available across the country this year, what state has the most job openings? If you know or you want to guess, send your best guess to trivia@realestateguysradio.com, trivia@realestateguysradio.com. Give us your name, the state name, and your mailing address. First person that gets it right gets Think Big. That's today's real estate trivia question. We're talking with the apartment king, Brad Sumrok, about getting into a deal, not just from the perspective of a great cash flow, awesome tax benefits, excellent return, but really understanding the property to the level that we can underwrite the risk. And Brad, many listeners may know your story, but if you're new to learning about Brad Sumrok, your first property was not a single-family house or a duplex. Your first property was a 32-unit apartment building, and you've always been very apartment-centric. And apartments are one of our favorite asset classes within real estate, that's for sure, but it's a little different than buying a single-family house, especially when it comes to due diligence and inspections and underwriting the rent roll and all the other risks. If I'm going to buy a single-family home, I'll probably hire a home inspector to go through and give me a detailed report. When you're buying 318 units, that's a whole different animal, and we talked about the property. Let's transition into talking about perhaps the most important item when it comes to passively investing, and that is the team, the folks putting the deal together. There's really three ways to invest in apartments, and I know you invest all three of these ways. You can qualify yourself, use your own money, get your own loan, buy the apartment building yourself. You can become a general partner and organize the group that puts it together. We call that real estate syndication. We're big fans of it. Or you can passively invest with someone who puts together the deal, knows the market, has a track record. So if you are a passive investor, then it's critically important that you underwrite not only the deal and the market, but the general partners.
Yeah, so look, I do, like you mentioned, I do all three. But, I invest as a passive investor in deals. Yeah. And I also invest as a general partner in deals, but rarely, if ever, going forward, or at least in the last few years, am I the sole general partner.
Right.
Why? Well, number one, because the sole general partner, if you think of all the things a general partner has to do, it's a lot. And I'll just get you mentioned it, but it's like find deals. And there's a skill and an art to sourcing deals and networking and getting to know brokers and owners and going to conferences and, relationship and backslapping and all that type of stuff. And then once you find it, you got to analyze it, and there's the underwriting and there's the market analysis and, and we've talked about that. And there's the CapEx analysis. And then you got to get a lender involved and get a loan quote. And then you got to do the physical due diligence and lead that process. You don't do it yourself, but you mobilize the team and you hire the property management company. And then you oversee the asset once it's closed and do oversee the CapEx and the investor relations. So that's a lot. That's literally like a full-time effort for one person. Yeah. But the beauty is if you could meet co-general partners that have synergistic skill sets where you could divide things up, then it doesn't become so much of a burden for one person. The challenge is how do you meet the GPs? So I'm going to talk about GPs.
Yeah.
And what most people do is they, and as you know, I have a program and I have a community and I know what I say from the stage, but a lot of people just don't listen and they meet people that they kind of like and connect with and maybe have a beer at the hotel lounge after the event. And next thing you know, they're doing a deal together. And I'm like, well, how much did you guys really get to know each other? Like, how much do you know about each other's values and what life means to you versus this person? And what is their skill set and what is yours? Like, what if you're both great project managers, but none of you are really good at deal sourcing or raising money? Like, you're going to have a problem.
Yeah.
So it behooves everybody to get to know, like, and trust people. And to me, that should be a longer process than when most people do. It's like you don't marry a man or a woman on your first date. Well, some people do.
Well, yeah, but it doesn't always turn out very well. But this is a great point because we tend as human beings to be attracted to folks who are like us. If I'm a deal junkie, I look at another person in the space and say, wow, oh, that person's great. They're a deal junkie too. But in reality, what I probably need is someone that is skilled in the areas that I'm not.
Right. So I always tell people that you should have meetings with your co-general partners to figure out who's going to do what, who's going to be accountable for what, what's their track record or education or aptitude to do that role, and how are we going to make decisions, and how are we going to divide up how we're going to be compensated. Like, these things should be done in advance, and a lot of times it's not being done. So I think that's a problem.
Yeah, I think that's critical. You know, we might get a sense of what a partner's going to be like when everything's going well, but it's when things don't go well that you really find out who's your foxhole buddy and who's not.
And again, how do you know how somebody's going to behave when things don't go well? Sometimes you'll never know until things don't go well. But again, if you look at choosing your partners as a courting process, where you might have multiple touch points with them in multiple environments, maybe not just over lunch or just at a networking event. You know, maybe it's you go to their home, or maybe they come to your home, and maybe you have dinner, and maybe you have lunch, and maybe you have different experiences with them, so you can see how do they treat the servers? How do they treat their spouse? How do they treat their kids? How do they treat, you can learn a lot from people if you spend enough time with them. Oh, and then also with the co-general partners, like, you should have frank conversations about income, net worth, liquidity. If I'm going to invest with somebody, like if just say me and you, Robert, are going to be two GPs in a deal, I'm going to say, hey, here's my financial statements. Could I see yours? And if you say, hey, I don't want to share that with you, Brad, all you need to know is I found a deal and I'm putting in $100,000. I'm going to be like, no, like, are we both going to be on the loan?
Right.
What's your net worth? If yours is $100 million and mine is $1,000, well, that's good for me, because if something goes down, they're going to come after you, not after me, if we're both on the loan. But I don't have anything, right? You have all the money. So, like, general partners should have these frank discussions about liquidity, income, net worth, what they're bringing to the table, not just with skill sets, but with experience, with track record, with financial resources. I've been teaching and preaching that for 22 years. And then limited partners, they should be pretty much doing the same thing. Who's the GP team? How are the decisions going to be made? What happens if, in the unlikely event that there's a market downturn or need for additional capital? How is this going to be handled? And the reality is, all these things, for better or for worse, they're outlined in the company agreements. They're outlined in the PPMs. Investors that are accredited and sophisticated should understand this. And I will say it's their responsibility. But I also think it's a best practice for the GPs to make sure that people understand it, and not just, look, I do deals, I raise money. How do I make sure that everybody read my agreements that signed them? You can't.
Yeah.
But you could get on, like you do educational webinars. You explain to people your business plan. You every time we've done a raise, we walk through, here's the potential risks. And it's not just boilerplate. Right. Some of these things could happen. Some of these things have happened. And some of the things could happen here. And you could potentially lose your investment. Like, I've said that in every one of my deals that I've ever done.
So, Brad, I have a candid question for you, because you're a guy that trains people on understanding apartments. A lot of your students invest in single-family homes or small retail, and now they're learning to invest in apartments. And there's a lot of training available in your program. But these folks are new. They're new to bigger deals if they're on the passive side. They're certainly new to raising capital if they're on the general partner side. And yet, at the same time, if I'm an investor and I want to bet on a jockey, bet on a team, I don't want the person that's never done an apartment deal, right? I want the person that has experience and relationships and kind of been through the war, if you know what I mean. So how do you balance the new, enthusiastic, excited, invigorated student without a lot of experience with the folks in your program that do have track record and experience and have done hundreds or thousands of doors?
Yeah, so one thing I'll be really clear about is we don't do the matchmaking at our community. Right. And so what we encourage is this best practice, is everything that I just said. Hey, have meetings with people, get to know people, have frank discussions about their skill sets, their financial resources, make sure it's the right fit. Yeah. Right? Can they do it? Will they do it? Do they have the resources to do it? So you got to make sure it's the right fit. So it happens organically. And if you're asking about how we do it in the Sumrok community, is that we teach the best practices. We like to show examples of people that have done it well and that have partnered together on multiple transactions and how they've split up whether it's the money, how they get paid, with the roles, the responsibilities. So we highlight the success stories, the case studies, and we use those as examples for people. And so, there's a lot of examples, and there's hundreds and hundreds of successful examples. However, that doesn't mean that, you can lead a horse to water, but you can't make every horse drink. So some people do things on their own. Some people make poor decisions in terms of the properties they buy, who they invest with, who they GP deals with, and they don't have these discussions until there's a problem, and then they end up having disputes.
An ounce of prevention is worth a pound of cure. All right, Brad, this is great stuff. Appreciate it. But hey, before I let you out of here, I do want to find out the latest and greatest when it comes to your big annual event, AIMNATCON, the Apartment Investor Mastery National Conference. I've been at every one of these. It's always a great event. And it's really for folks in every walk of apartment life. If you're brand new to apartment investing, you're going to dig it. If you're a seasoned person who's done a lot of passive investing, or even a GP that's put together lots of deals, there's a reason to come to AIMNATCON. How's it shaping up for this year?
Yeah, it's well, first I'll give you the dates. August 25, 6, and 7.
All right.
Dallas, Texas. This is the one apartment investor event that you don't want to miss, okay? And you know why? Because every year, I believe it just gets better and better. This will be our 6th year. We've had people like Robert Kiyosaki, Grant Cardone, Ed Milet, Damon John, Jesse Itzler, a lot of big name people. We've also had people that aren't so well known but own tons and tons of deals, like Charlie Young and Brandon Turner with Bigger Pockets. Like, we've had a lot of people that own a lot of apartments. Yeah. And of course, yourself and Tom Wheelwright and, your partner Russell. And we already have a few speakers lined up, but I'm not going to say who they are, but it's going to be really good. Okay. Yeah. It's going to be good. And the other thing is I always try to make that event different. So we're not going to always have the same speakers every year and cover the same topics. And, now more than ever, it's important to understand how to win. And one of the biggest things that I feel right now and see is there's a lot of fear out there. The other thing we're going to be covering, and I just covered with you, very recently, is why now still makes sense. Yeah. And if I could just outline that real quick too, but real estate is on sale. It's 20%. There's been a pricing reset. It's 20% down from where it was last year. Instead of having 30 buyers, there's 3. Yeah. And they don't even do best and finals. They might have 3 buyers chasing a deal. The buyer-friendly terms, I haven't seen the buyer-friendly terms like I'm seeing now since 2018, 2016. Yeah. It's not a complete buyer's market, by the way.
Not yet.
But it's a big shift. There's been a shift in pricing. There's been a shift in terms. I don't know anybody in 2009 and 10 that said, I wish I would have bought less real estate.
Right.
So I'm selling 3 of my deals now, and I'm going to be redeploying as much money as I can this year in 2023 because the fundamentals are strong. We're still in an inflationary environment. Inflation favors 6-month and 12-month leases like we have with apartments. Apartments are outperforming virtually every other type of commercial real estate, office, retail, storage. It's outperforming all of those things. People need a clean, functional place to live, and there's the cost of buying a median-price single-family home has skyrocketed. So what we call the affordability gap, which is the average price of renting an apartment versus buying a home, is $1,100 a month cheaper to be a renter. Yeah. So we're in a day and an age where everything is favoring renters. Yeah. And it's a great business to be in. Oh, and the depreciation this year is better than it will be next year. So if you're paying tax, as our friend Tom Wheelwright says, if you're paying tax and you want to pay less tax, you're going to have a better tax advantage in 2023 than you will in 2024. But, going back to AIMNATCON, great event, 3 days, powerful speakers, and we'll be teaching a lot about what it really takes to be, and I'll make that claim, what it takes to be a millionaire apartment investor, because we've helped hundreds of people do it.
Yeah. All right. Love it. Hey, if you want to learn more about AIMNATCON or Brad's Rat Race to Retirement event, or even get access to Brad's 2023 apartment forecast video, just send an email to Sumrok. That's SUMROK, Sumrok at realestateguysradio.com. You'll get all the details. Brad, as always, thanks for sharing your wisdom with us. and your big heart for folks that want to get involved in apartments.
Awesome. I enjoyed it.
You're tuned to the Real Estate Guys radio program. More when we come back. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hey, this is David Green, author of Long Distance Real Estate Investing and the Burr Book, and host of the Bigger Pockets podcast. And you are listening to the Real Estate Radio Guys.
And welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. It's not too late to get yourself signed up for the 21st Annual Investors Summit on Sand. Takes place right around the corner in beautiful Ambergris Key, Belize. Come join the Real Estate Guys, Kenny McElroy, George Gammon, and an all-star faculty. Get all the details by sending an email to summit@realestateguysradio.com. Summit@realestateguysradio.com. Well, always good stuff from Mr. Brad Sumrok.
Yeah, you started out at the top of the interview, Robert, just talking about that seat time, about how important it is to really have some experience. And one of the advantages that a lot of new investors today, people who started after the great financial crisis, are going to get, if in fact this does turn out to be the recession that the Federal Reserve seems to be committed to imposing upon the economy, is that they're going to learn how to underwrite in a difficult time, in a difficult economy. All boats rise when there's a flood of free money in the marketplace. But with these aggressive interest rate hikes that have really sent shudders through the financial system, any asset class which is really priced by its cap rate, if you will. So when interest rates go up, asset values go down, and that's true in apartment. So when cap rates rise, because the cost of capital underlying them went up, then prices are going to fall. And if you've not underwritten in anticipation of that, then you're going to end up having a tough situation. So you do have to adjust what you're doing based on the new realities. And I think one of the things that I appreciate about Brad is Brad just doesn't have a formula that he's used, same formula for all these years. The principles of his underwriting structure, property, market, team, those are the basics. But the properties in the markets, and especially the financing structure that you use, they're modified, if you will, based on what's happening in the marketplace. And right now we've had unprecedented level of change just in terms of scope and speed. And it's really creating some angst out there. Now's the time to really double down on your underwriting skills and make sure that you're really understanding how a deal works and having plan A, plan B, plan C.
At least once a year, Brad does his Rat Race to Retirement, which is an introduction to investing in apartment buildings. And of course, in August, his 6th annual AIMNATCON. Plus, at the beginning of each year, Brad does a really cool apartment market forecast. If you want access to all that, just send an email to Sumrok, S-U-M-R-O-K, Sumrok@realestateguysradio.com. We'll get that to you. Underwriting is maybe not the most exciting and fun part of real estate, but it's absolutely critical. And when you do it right, it is that ounce of prevention. And it makes sure that even though it's not a guarantee, you've got a better than average chance of an investment that'll work. Hey, thanks to Brad Sumrok for sharing with us today. Next week on the show, we've got a gentleman who was the director of the Office of Management and Budget for the United States under Ronald Reagan. He is a smart dude. You're going to dig it. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life, powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct, asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.